So, John, thank you so much for joining me
You're
today.
very welcome.
Can you tell me about the macroeconomic trends that are impacting transportation investments in Europe today?
Yeah, I mean, certainly a very lively sector given the dynamics that came out of COVID. What we see both in our portfolio and also new investments we're looking at, pretty strong recovery across the board in terms of both passenger and freight assets. Particularly on the freight side, there are really strong volumes despite the headwinds on global trade. What we've also seen is a greater consolidation amongst asset owners. So we're seeing a greater sophistication and scale in terms of the shareholders who actually own these assets. And we're seeing that come through also in some of the more, I would say, efficient management of assets. So as COVID put strain on cash flows and earnings, management teams and shareholders really stepped up to try and figure out ways to optimize their underlying businesses. And we're seeing that particularly in things like greater use of digital to understand the consumer and customer behavior and the reasons for travel, the reasons for use. So there's a few things there, but generally we're seeing pretty positive credit trends on transport, and that's why we have been allocating significantly in the last couple of years.
And of course, we are seeing a lot of interest in private credit. How does that impact this particular sector then?
Yeah, well, the private placement arena has definitely served transportation well in recent years. And I think that's, with many sectors, it mirrors a US market that's very mature, with borrowers and investors understanding exactly what they're looking for. In Europe, that has begun to become more established. We see borrowers who have access to the PP market here, both from European and US accounts and maybe beyond. And they get comfortable with that, and then they can use that model for forward financings. What we'd also call out, though, is it establishes a connection between the borrower and investors. So where they need more tailored, more customized solutions, perhaps outside of a vanilla private placement process, they're still talking to the same people. There's a greater degree of connectivity between private debt and the borrowers and the management teams themselves.
And then relationship building
Exactly
through that.
right. Yeah, and they understand that private debt investors, yes, they have to manage their portfolios carefully, but they're equally looking to back management teams and shareholders as owners, as equity, to really make the business work and form the business plan and then review it. So it's, I would say in most cases, a harmonious relationship, one which is quite pragmatic.
All right, interesting. So then I wanted to touch upon the transportation industry then. I mean, we've been talking about decarbonization trends and sustainable finance for a couple of years now. Is that still a key consideration?
In Europe, I would say absolutely. And for us, as we think about the next 5 years, but actually beyond, then we see capital investment really being targeted on reducing carbon in the value chain of various transportation subsectors. For us, that's where it starts. That's the core. Why is a particular asset looking to do a certain capital investment plan? What is the rationale? What is the policy and macro framework? We examine that first before we get into some of the more nuanced and detailed considerations of the sustainable finance terms and conditions. So certainly big picture first, and then we get into some of the detail. Where we see the biggest investment flows needed, surface transportation in Europe is well known to be lagging in terms of its decarbonisation efforts. Really, that's about road. And so there's a lot of focus from our research on the electrification of road transportation and getting it right. So we're very mindful that early stage EV charging networks, for example, they have some of the characteristics that we're looking for as an infrastructure credit investor, but we're looking for it to become more stabilized, more established, perhaps before we deploy particularly some of our lower risk capital. So that's on the surface side. And then on maritime, which again, I think has lagged a little bit in terms of the focus. And we're seeing it come through now in some of the vessel owners, whether that be passenger or freight. They're starting to invest more and more in alternative propulsion technology, in some of the ferry assets that we have in the current portfolio. We've seen new ferries come into the portfolio with zero or low carbon emissions in terms of its propulsion. So things are happening, and we want to be a part of that.
And maritime is, of course, one of the biggest polluters historically. And,
Indeed.
Compared to any other country as well, like it's actually more.
Indeed. And, there's been a lot of conjecture around deglobalization and what that means for global trade. Our sense is that global trade is vital. Those links and those networks are well established, but people are going to be smarter about the routes that they favor and prioritize. And they're also going to be very mindful of the carbon footprint in terms of those routes. And so for us, it's a chance to invest in the capital assets and also back the businesses that are being more efficient around how they plan the network. And also we see advantages for those that own assets around, whether it be regions or global. That diversification has clearly benefited some operators in the freight sector as uncertainty has been pronounced, say, in the last year in terms of trade policy.
Hi, John, thank you so much for joining me.
You're very welcome.